Happy Wednesday, or as Mayhem likes to call it, Fednesday. It is November 1st, 2023. Welcome to another midweek update with Horse and Mayhem. And also, welcome back, Mr. Mayhem. I'm very thankful that you're here. I did this alone last week. That was awkward. Much better having you back in the driver's seat here, especially on a big day like today with FOMC to break down what happened, what you're seeing from the bigger picture. How's your week going so far? Welcome back from vacation, man.
Hey, thank you so much. It was good to have some time off. Appreciate you covering for me. I know there's a lot going on out there, so I tried to recap some of it on navigating the markets between last week and this, but there's so much going on this week and really just in a bigger picture to cover that we're going to go through a lot of that. But first, let's just recap what happened today. And today was interesting because, I'll say actually Granny Yellen's QRA or quarterly refunding announcement was actually probably more important than the Fed because we got some information that I think we need to weigh both in the near and intermediate term. In the near term, it sounds like good news because there's going to be less issuance on longer duration notes and bonds particularly. And so that takes some of the pressure off bank reserves and that sterilizes some of the potential impact of an outsized issuance, about $750 billion per quarter, the first quarter of their 2024 being this quarter for us, and then their second quarter being our first quarter of 2024, since they're on a weird fiscal year schedule. That being said, what we do know about these QRAs is that they always get upscaled. So we've seen the Treasury upscale these by 20, 30, 40, 50%. It wouldn't be too surprising if we see that again in more longer tenors, depending on where the long end is at that point. Right now, they might be cautious because they see that pressure. They see that bear steepener that's been pretty violent. The 30-year bond is down something like 50% in price from peak to trough. And that's a really big decline in sovereign duration. So I believe that might have been one of the reasons they sort of stepped off that. Now, I will also comment on Stan Druckenmiller's remarks just briefly as to say, I understand where he's coming from, and I'm not a huge Janet Yellen fan by any stretch of the imagination. But I think he's coloring his views a little bit with his politics more than the reality of the situation. I think there was some consideration here when rates were ultra low about how much duration to issue, full well knowing that normalization would be toxic to the value of these same. We know the Silicon Valley banking bust happened, as did First Republic and some of these others, in part because of the losses on this same type of paper. Shorter duration than the 30s, but 5s, 10s, Ginnies, Freddies, Fannies, other agency mortgage-backed securities. And the problem is that if they put a lot of longer duration issuance out there, there would be more pain in the banking system and in the pension system right now. So there might have been some of that consideration. Nevertheless, the Treasury did go from an average duration of less than 5 years to over 7 years during that period of ultra low rates. So there was some more normalization than perhaps recent commentaries have suggested. The Fed meeting, it wasn't really anything. And I kind of joked about it over the last few days that we're probably just going to hear nothing at all and be told to be happy about it. And that's pretty much what we got today. It was like, oh, yeah, we're not really planning to make any meaningful changes from our commentary, which is basically expect maybe 1 or 2 hikes. It'll be driven by data. What that data actually is, we're not going to tell you. And when it happens, you'll know when it's happened.
Pretty good summary right there. That would have saved all of us about an hour's worth of time earlier listening to what he said. If it would have just been that.
It's gotten to the point where I have memorized like his speech.
He doesn't change it up much, does he?
It really is
to the same old script over and over again.
It really is. I really liked 2022 Jackson Hole Powell, if even for just the dynamism.
Darth Powell.
Yeah, because he was like, he had some flavor. He was like dynamic. It was like, oh, wow, you have personality today. This is great. And then he just kind of shrunk away from that. We've never seen that version of Powell again. But even if it's not to bring fire and brimstone, if he could just have some personality, it would be fun. It would
He's probably just struggling in his day trading, probably.
He is,
it's a little grumpy about it.
Yeah, his Apple calls didn't do too well this time around. He's really hoping Tim will rescue him tomorrow. So we'll see how well Tim can cook.
Oh, nice.
So let's see here about the equal weighted S&P versus the mega caps. The mega caps are up about 54% over the last year. And the equal weight, well, they're down about 1%. And so it's
Unreal.
interesting that dispersion between the really heavyweight, high size of market cap companies versus everyone else. And the most interesting part about it is this is not really what risk on looks like. This is what a flight to quality looks like. This is when people are scared, they're buying these things in the sense that if you have to be long, if you have a 90% cash allocation to equity mandate, you don't have a terrible amount of flexibility as to where you can put your money, or you're just not particularly creative with it, then you're going to go into these because you're going to use size as a heuristic for quality. And the mega caps are the biggest. So obviously in that mindset, they're going to look like they're the highest quality things to buy. And they're not terrible. It's just the valuations have been a little bit skewed, particularly with Apple putting on $1 trillion of market cap when adjusted for buybacks, its earnings are actually down. Is, it's really quite a fascinating phenomenon, just put it that way. But this is going to be interesting going into tomorrow, and it's not necessarily about what Apple says. It's about how the market reacts and how many buybacks they authorize.
Pretty good observation, if you ask me. There's a lot riding on Tim Cook tomorrow. I speculated in our Discord, and I could be totally wrong, but I speculated that I think Apple's earnings is going to be more impactful for the overall market than the Fed was today.
Yeah.
It was pretty much a nothing burger from the Fed.
100% agree. I think the Apple's earnings are much more important to this market. I think everyone went in expecting nothing from the Fed. We got it was everything we hoped it could be. So now we have to go into Apple wondering if Tim can save the world again, and so it really is up to Apple. You look at market breadth here. The percentage of S&P components below their 52-week high. This is not great to see so much of the market really weakening in its overall breadth. And we can see this in multiple measures. So the more we look around, the more we see this kind of overall look of weakness underneath the surface. This is the NASDAQ new highs versus new lows. We recently made the most new lows since the Silicon Valley banking crisis. And that was a pretty decent breakdown. And then after that, we actually made the most new lows since October of 2022. That was that blip that happened just several days ago. Now, the reason I bring this chart up a lot is this is just not what a healthy market should look like. There shouldn't be these rolling, increasing new lows under the surface. There should be much broader upside participation. In fact, every single bull market from the bear lows from 1982 on has had small caps an equal lead and market caps follow. This is the exact opposite. And that's why it's kind of like in the back of our head, we need to be concerned about it. It also means there's been opportunities on both sides of this market all year long for bulls and for bears. So, without any kind of bias, just looking at it objectively, this has been a pair trader's market. This has just been
true.
Really the sweet spot for swing trading in pairs. And I remember earlier this year, we had that long Japan, short China trade, talking about putting it back on now. But that's another one of those kind of opportunities where we're seeing these relative strength and relative weakness ratio charts that tell us, some of these pair trades are ready to go back into. Still watching SPLV versus SPHB for another entry. Loving the idea of XOP versus GDXJ as a really interesting long oil and gas, and short the junior miners, which are just some of the worst run companies on the planet. Like, I think if we had a contest between GDXJ and the Russell 2000 growth companies, it would be like a great contest for the worst companies on, at least in the US.
I was going to say, is that really a contest? There's no winners, man. I think you got to have a winner.
Who's the biggest loser? The contest is who's the biggest loser, right?
Gotcha.
Like who gets dunked?
Well, you know where my boat's going.
I know, right? We probably have some juniors in the Russell 2000, so maybe we can have a crossover and just say, you know what? It has all the worst of everything. Just send it to zero. But it is making new lows this year. That's not a good sign. We make fun of the small caps all the time, but we have to be honest. This is a heuristic for appetite for risk. And when the small caps are rolling over on a day like today, they couldn't even really catch much of a bid. That's not a terribly healthy sign for the market. So it's just another thing to keep in the back of our heads. It also probably means that if there's a place to fade, if we're going to see this, selling come back to the market, that's probably the easiest place to go because it's been the weakest. And there's just so many reasons for it. A third of it doesn't make any money. There's all these regional banks that are in trouble. And there's also a pair trade in there. I talked about this in yesterday's video. Long small cap value, short small cap growth, IWN versus IWO, is actually a decent trade. Now, Horst, you're going to hate me because I'm long the value factor of the Russell 2000. So I hope you can forgive me one day. I know you're going to not talk to me for a while after this. But on the other side, to my credit, I'm shorting the growth factor, the IWO. So I'm net like delta neutral. If you're going by hedge fund math, which is never 100% honest about that, I would be delta neutral. So I don't really have any exposure. So maybe you can forgive me because it's just sort of a line item.
Oh, no forgiveness needed. Your pairs trade have been amazing this year. So I'm all ears. Every time you bring up a new one, I write it down.
Excellent. Excellent. All right. So next one we have here is a NASDAQ. The number of the stocks in the composite that are above their 200-day moving average. Now, I have this big box in green because this is what a healthy bull market looks like. And you can zoom this chart out to weekly, monthly. And it's just the idea that there's more and more stocks above, 50% or higher are above their 200-day moving average during a healthy run. And we just kind of gently nudged that level earlier this year, then almost got to it over the summer. And now we're just at 21.13%. It's a little exhaustive. I mean, that's me kind of saying, we could get a little bit of a bid here in the broader index just because of how exhaustive this is. But at the same time, this is, again, a sign that there's not a lot of upside participation distributed across the index. Now, let's take a look at overall positioning from managed money based on the survey from NAAIM. It is at 24.82. That's the lowest level for 2023. That's the lowest level since September of 2022. And that's this exhaustive distribution, which to me is very interesting because these guys used to just sort of buy rips and sell dips. Last time they got really long, they got up above 66. You can see it there in the chart in the third to most recent candle. They were buying the dip, but the dip kept dipping. That dip had hands. And now they've pretty much flushed all their longs out. They're the most conservatively positioned that they've been this year. So to me, that was like an immediate sign of, okay, these guys are almost always wrong. There's probably a bottom in here somewhere. That was one of the reasons that I was saying, maybe 4150 on ES could be a pretty interesting level around that yearly volume profile, maybe a little lower around 4137. That could be an area we started to get a pop. Indeed, we did. And it makes a lot of sense because there was just so much exhaustion underneath the surface. Here's AA versus II, bulls versus bears. This is another one where, I wouldn't call it exhaustively low, but at least flushed all that enthusiasm from the summer where people were the most bulled up they'd been since November of 2021. And we all know what happened next after that. That's been flushed out. Now it's neutral. It's not exhaustive, but it's still a good sign to see, the retail investors and traders surveyed not be super duper bullish. Because if you're looking for counter trend pops to raise cash, to hedge, or to even sell directionally and get some shorts on, this is the kind of thing that could lead to that pop continuing. So why will this chart matter for us this month? It didn't matter last month. It didn't matter as much as it should have, as people thought it might have in October. We were supposed to get some mid-month on possible boost in seasonality going back several different time frames in the market. Of course, we got the opposite and it rolled over. But a lot of the times October can be kind of a spooky month. A lot of markets, that are going to become more fragile. That tends to happen during that October month. So we did see that play out indeed last month. Now we're in the first day of November. And the question is seasonality going to give us a boost? Have we seen the selling kind of front run all the other kinds of distribution that's going to happen? Are we going to now see this boost from this washout in positioning and sentiment? And, if we look at Novembers in the past, just going 20 years of trading history, 75% of the time it's up about 1.8%. So it does suggest there's room here, not only based on some of the positioning data and some of the exhaustive selling we've seen, but also based on seasonality, if it's going to matter. And I say if just because these are just statistics. It doesn't mean it has to happen. It just gives us some sense of probability. Now, U.S. share buyback authorizations are kicking back into full gear. So as we get past Apple and really the rest of this earnings week, we're going to start to see these things kick back in over the weeks ahead. And that will add some positive flow, and that will help to put a bid underneath a market that's otherwise been pretty pretty illiquid and pretty poorly bid over the last month or so. So as we get out of that blackout, we're going back into a year where there was basically the third most buybacks authorized ever. So it's significant. Now, companies don't have to do them. They're just authorized. But, if they see the opportunity to deploy cash in that way, and they decide they're going to do that on the basis of saying their stock's cheap, or they just don't know where to put their money or whatever else, then we're probably going to see a pretty healthy bid in a lot of the larger cap companies. These are the ones that tend to do the most significant buybacks. And then another exhaustive indicator is CTAs. They are the second most short that they've been in a long time, really going back to 2018. So this is exhaustive. This tells us that if momentum continues to start turning the other way, there is a pretty solid bid that could come out of these momentum-driven traders. And single stock shorts are becoming heavy, so there's probably some crowded trades in some of these single stocks that they might have higher short interest that might get squeezed by call buyers if we do go into one of those upswings. So looking for some of those single stocks, some of the factors that hedge funds have targeted are energy, utilities, staples, these areas of the market that for whatever reason they are hiding in them and then going very, very long mega caps have been pretty popular short trades here. And as we go into November, it tends to have strong flows for another reason, and that's retirement funds tend to do their final topping off of the year this month, and that can add further to those passive and active flows that bid the market. So we are looking at 4,400 S&P as a pretty massive wall of calls. We're looking below us, however, at a much more significant wall of puts at 4,200. And that's also where there'd be a large volatility trigger. So if we did move that much lower, that could actually add to the erratic trading patterns of the market. And then the model is putting the gamma flip level at 4,305. So we're really not very far, just about 64 points away from flipping into positive gamma, which would change dealers from being sellers of dips and buyers of rips to kind of being neutral. And then the further we go into positive gamma, that would put dealers in a position where they'd be more likely to be sellers of rips and buyers of dips, kind of stabilizing price action. So we do have a number of potential dynamics if the market keeps moving higher that could improve liquidity and reduce volatility and give a chance for further upside. And one area that I'm watching for downside potentially here is gold.
Yes.
And the reason I'm watching for gold, and I love hearing that you're excited about this too.
Who's not excited about shorting gold? It's the best trade in the market.
There's a whole contingent of gold bugs that are going to want to crucify us for this. But I'll just say, look, at the end of the day, when we look at gold, this move has been exhaustive. It's starting to show signs of reversing. I've been trading gold for a long enough time that I know when we get this big parabolic rip and then the catalyst for it doesn't continue, that the longs tend to get taken advantage of and they get flushed out of the trade. And I think we're in another one of these now. It doesn't mean we can't consolidate for a bigger move on a catalyst, but I think the risk is fattening on the left side. I wouldn't want to be long this trade right now. I would be looking for fades. And one of the biggest reasons for that is from just an intermarket relationship perspective. When we're looking at the long end of the yield curve on 10s, price of gold and the price of 10-year notes tend to track. And that correlation goes back some ways. And yet for some reason, from the summer of this year, it broke down. Now, I don't think it's over. I think both real and nominal rates do matter to the shiny metal, which pays no dividend. And as a result, once this fear trade in gold starts to fade, which I think it may, I believe that it has some room to catch down to that 10-year note. So I'm looking at gold for continuation of the downside as a momentum shift that gets me to want to short some of this. And I believe that on the other side of it, I would be very interested in taking some of these longs in energy. So again, long XOP, short GDXJ is another way I would express this view. And let's take a look overseas. This is Europe. It looks kind of terrible. It's just been this rolling top. Looks like we're going to go right back to those lows that we experienced during the spring rout, where over there Credit Suisse was imploding and had to be bought out by UBS with the help of the Swiss central bank and government. I believe that this little move today, if we don't have continuation above the 20, could open us up to a retest of at least the initial wick of those lows around 39.82. So this is just one of the signs that there are some shaky global markets in emerging and developed territories, but there are exceptions to that rule too, and the Nikkei is one. I love the Nikkei here. I don't know how many people trade it, but if you want to express that trade without yen exposure, you're going to want to look at HEWJ, not EWJ, because EWJ exposes you to the yen, and I well, you can look at the charts between the two and you'll see for yourself that hasn't been a good proposition. So when we're looking at the Nikkei, I'm looking at a move to 33,000 if we can build from this breakout of what might be a large bull flag pattern. And that would be an area where I'd want to just take the position off entirely, because even though there's some good value in Japanese stocks, with everything that's going on and interest rates in Japan set to potentially continue rising, I do want to be a little bit cautious about how long I am in these positions and how much risk I'm taking. So this would be a smaller size trade that I'd be looking to keep on for no more than 2 or 3 months, and I'd be getting out of it at that price, or if we get above there and then start to chop below that point of control. We're looking at copper here for a potential trade. It does look like it's trying to break out of this downtrend on persistent rumors that maybe this time is different and China is going to actually do something that vaguely resembles stimulus. We'll see. But I like this idea of if copper can break above $3.68, that we have room potentially to move higher to that point of control. So this wouldn't be a huge trade, but it would be a sort of reversion back to that point of control. And then we probably get kind of stuck in that area of the auction and in the volume profile where it's probably going to be pretty sticky. And we can see we've been stuck there before for some time. So this is an area where I would just want to completely get out of it. Risk is pretty easy to manage. If we broke below $3.68 to the downside on a closing basis, I would be out of the trade. And we have XLE. This is one that I'm watching for long, not ready yet. But if we break above 86.14 on a closing basis, I'm in for 89.19 to the upside, and then stopping out below that same level if we close below it.
Yeah, I actually just posted something back on that chart. Sorry. It fired an exhaustion symbol from the sellers yesterday, which worked okay. Not great. You got some more selling pressure today on oil, I think translated over here. But I'm in the same boat. Very interested in XLE right now. Don't have a position. But I'm actually kind of thinking the other thing. So I didn't include an oil chart today, but I'd almost rather buy if they smash this thing down. That's at least what I'm speculating right now, because obviously we know, you have some natural buyers for oil. It's nearly impossible to be bearish oil right now, at least for me. That personally, I know there's a lot that are, but I'm kind of curious about buying the stop run here if they really flush this thing down closer to 80. I don't know that they'll get it, but anyways, just my thoughts. Either way, I'm very interested in XLE with you. I just don't have a position yet.
So you'd be looking for sort of like a look below that gets bid up really hard.
Well, listen, it's been 3 straight days of selling. Yeah. I know I'm talking oil, not XLE. Yeah. So I know it's not fair. It's not apples to apples, but 3 straight days of really aggressive selling that is getting absorbed over on crude oil. But clearly somebody has a reason to continue to sell this thing down in the face of, potentially massive military conflict around the globe. If things escalate, you have to ask yourself, that's a really strange dynamic to have something like war on the horizon and see so much selling pressure in oil, which leads me to believe that somebody has a reason to want it lower. And I might be better off trying to buy that dip. If they really rip it down there towards, you see that high volume node down by 81-ish, somewhere in that region is now what's getting my attention. I loaded up on USO calls yesterday and closed those today around the market open about 90% of that position. So I'm still technically long over there, just barely. But I'd like to add on a flush, because I can't ignore the fact that somebody's selling the crap out of this. It just can't get up. And I'd like to see that finish out. Just finish what you're doing, whatever reason that you have to be selling oil in the face of, global conflict doesn't make sense to me. But I think this is an opportunity where I could take advantage of that if they're successful. And if you draw a little trend line, from those lows there in mid-March on your chart all the way up, I think you'd get nice support below where you have that final line at 84. So even if this is sort of like a two-way trade, because I like the way you have it set it up right now. The exhaustion symbol for me already fired, right? So if it does break above that 86 level there, I agree with you. I think I would be forced to take some longs because the thing's taken off. But the alternative scenario that I really like is a knife down around this 82 area on XLE.
Yeah, I think that's very interesting. I hadn't thought about it that way, but looking at it from that perspective, if we had that kind of price action, it seems like it would be a steal. So definitely always interesting in hearing your thoughts and comparing notes. Yeah.
Sorry, I didn't mean to interrupt you. I was just saying, as a disclaimer, I'm not like a full-time oil trader, but I've been watching it more this week than I ever have, just given everything that's going on. And it's been consistently alarming to me how much selling pressure there is considering what's going on in the world. So I feel like, well, there's an agenda here. Why am I continuing to step in the way and long this thing if somebody much larger than me is routinely selling it down as hard as they can?
Right.
So I'm stepping out of the way. I went down to runners. I'm like, all right, you guys finish doing what you got to do. And then I'm going to get back in because I'm definitely bullish oil. But at this point, I'm just not going to fight them anymore.
No, I mean, I 100% understand. And it's interesting just to add some color to what you're saying about conflict. The other catalyst over the intermediate and longer term is just there's a lack of supply and demand is firming up. And if China does anything even vaguely resembling actual stimulus, that's also going to have them topping off their reserves and adding actual oil imports to their economy at a time where global supply is tight and some of the most important suppliers in OPEC have been curtailing, like Saudi, and in OPEC plus, Russia supposedly at least is reducing exports. And so I think it all matters. And then with, the price of oil not really decidedly staying above the high 80s, you don't have a lot of the shale plays coming back online either. So we do have a constrained supply situation. That's another tailwind. It's hard to see oil, like West Texas Intermediate crude, go meaningfully below 80 for too long unless we really have a more meaningful global slowdown.
Aren't we a buyer at 7? Is it 78? Is the U.S. a buyer at 78?
I mean, supposedly they keep changing the map every time you talk about this SPR thing. They're gonna buy when it goes lower. Now they're gonna buy when it goes higher. Now they're gonna sell indiscriminately. Then they'll buy it. Like, who knows? I have no idea. This is honestly, I've never paid this much attention to SPR, but I feel like if we go through history, I don't know that communications were worse than they are now.
I have no knowledge on the subject, but I wouldn't doubt you on that. It is pretty wild, but anyways, very interested in energy here with you.
Yes, yeah, and look, and on the gas side too, very interested in natural gas plays. So let's shift gears into the technicals, Horace. I'd love to take a look at what you're seeing.
Yeah, sounds good. Starting first here with the S&P 500. In fact, that's what we're going to focus on most for this midweek update, technical analysis portion this week, because I think it's what matters most, given, what's on the table with what we just heard from the Fed, the change or the surprise, I should say, with the QRA stuff, and then Apple earnings tomorrow. I'm not going to get into as many miscellaneous markets this week for the sake of time. We're going to focus because I think this is a really important spot. Obviously, from the chart, I hope that you would agree it is, because the S&P 500 is back testing here the 200 daily moving average. This is over on SPX, not quite there on ES yet, but on SPX, which is really what matters, given that those options, especially the short dated ones, are the most influential in the market. We just came up here and kissed the 200 and sort of settled right around it. So this is a major crossroads that I am interested in trading. If, we'll get into the details a little bit shortly on how I want to do that once we zoom in. But a couple other things to know. One of the first things I have to admit is I made a joke about this in the Discord earlier today, but, I'm never going to fade my own work again. I'm very frustrated with myself this week. We had the exhaustion symbol here. This is an indicator that I've spent most of, this second part of 2023 trying to refine and have it in a place back tested that I really like it. And it works. And then I ignored it like a complete moron. When this thing fired off an exhaustion symbol, I should have been buying. So I'm going to acknowledge that as a mistake. I did play some call options. It's not like I've done bad this week. I should have put a swing on here. And I'm mad at myself for not doing that, because now I'm in the same position as everybody else. Do I chase or do I fade? I'd rather be in a position which my own work told me to take, and I didn't, because I just didn't like it. With everything going on in the world, the risk of escalation and the conflict overseas, I couldn't bring myself to do it. I deeply regret it now, but it is what it is. There's not much I can do at this point. I do think there's a good chance that momentum is turning here temporarily to give that maybe that little relief bounce that Mayhem talked about earlier. And as we go through these, hopefully you'll see why I think that. This is not a call to get crazy bullish. I'm extremely skeptical now of getting crazy bullish after seeing everybody else get crazy bullish today. And I'm not using the word crazy lightly. There was people on Twitter yesterday, some of which I respect, spreading rumors about what the QROA stuff was going to be, not data, not information, right? Like, I really respected your approach to this, Mayhem, because you shared data. You shared actual numbers. There was people running around saying, I'm hearing on rumors, all this stuff is going to be incredibly bearish. The market absolutely stuffed it in their face today, and everybody flipped bullish. Even on TV, I have CNBC in the background for a good laugh. They're all bullish now too. So I am a little skeptical, like, okay, that was a really violent flip of sentiment from the world is going to burn to everyone's bulled up. I am a bit nervous about that, to be honest with you. I don't like seeing sentiment shift that dramatically, because all it's doing for me is reinforcing that nobody has a clue what's going on. Everybody's still lost. Nobody's holding any sort of sentiment with conviction. They're flipping it in the drop of a hat. But that said, I don't think it's wise to ignore the surprise with the QRA stuff. That is meaningful. And I do think we saw a little bit of that repricing happening with bonds today, but there might be more in store. So over the 200 daily moving average here in SPX, there's zero chance I can be short or try to be short anymore. So that is my cutoff, and we'll translate that over here on ES as we get more into the weeds. But above the 200, there's a serious potential for the squeeze to continue right back up here, because we're back to home. We're back to where all the volume has been built this year. So at this point, it makes even less sense to have a super, bearish bias at this point, now that price has returned on strong volume back to its home base, quote unquote. And we'll show that in just a little bit. So we're starting zoomed out right here from daily candles, just to give a sense of the trend and overall momentum, which has flipped recently. They lost all the key daily moving averages. The bulls did here. But if we're going to reclaim the 200, which is the most important one, that makes it ridiculously hard to stay bearish this market, whether it makes sense or not. Let's move on to what I think is the most important chart on the face of the planet right now. This is the big eight, quote unquote, combined: Amazon, Apple, Tesla, Nvidia, Meta, Netflix, Microsoft, and Google. Simple calculation, just dividing by 8. We're not doing anything weighting here. I just want to see, are these stocks moving or not? Because they have been, as a group, the reason for the gains this year, as Mayhem covered earlier. If you're an equal weight S&P, you're not having a great year. If you were in full S&P, or, maybe even more biased towards the mega caps, you're crushing it. These stocks have been the most influential. I think they're going to continue to be, because there's zero reason to think that they won't. So if we break out of this wedge, it's something that I would take very seriously. I was speculating on Twitter that this was a false breakout. So far, I'm correct. That doesn't mean I have a position on to express it, though, right? So where I'd be interested in, same thing over on SPX. If we get above the 50 daily moving average here in this trend line, it would be impossible for me to stay short, whether or not I agree with it. There's too much to ignore at this point. You would have to ignore the buyback starting again. You'd have to ignore historical seasonality. We'll show a couple other charts in a minute that you'll have to ignore as well, but it would be really tough for me to do that. So all eyes on this chart. I think it's going to look very different come Friday after Apple's done reporting and the market's done digesting it. I do think there's a really good chance we're out of this wedge and the market is back into a state of motion that I would feel comfortable putting on large swing positions with conviction. Speaking of very influential charts, we can't not talk about the US dollar, given that strong inverse correlation between the SPOOs and the dollar here. It's worth paying attention to, even if you don't trade Forex at all. I would strongly recommend still watching a DXY chart just to get a sense of what the US dollar is doing through this basket, because it will impact the flows intraday for things like the S&P. You always want to make sure you're trading with the wind at your back. If the dollar is absolutely booming and really just ripping above this key pivot line, the wind's not at your back. It's going to be really hard for the indices to get off the ground. It's not impossible. It's just extra weight. If you have a rising dollar and rising S&P 500, that would be unusual based on their historical correlation. So the reason for showing this chart, we're right back to this pivot, right? It's very dicey place. We took a look above it in the dollar and then rejected. This is another thing that's factoring into my thesis that I think it's time to ditch all shorts and embrace the seasonality, whether I want to or not, and try to ride this thing out. So if we stay underneath 106.7 in my mind, that would be bullish for the equity indices. If the dollar continues to push back down, that's going to help. It's really hard to start. This is why I don't have one of those big positions on yet. It's hard to start a position for me so close to a pivot like this because you tend to get exactly what we're getting, which is chop. I'd actually rather miss a little bit of the trade and be late to see the dollar move away from 106.7 a little bit more. That's my personal pivot. Your line might be a little bit different, whatever works for you. This is the level that I've been watching very closely to help try to make some intraday decisions as well as some longer term swings. We're not far enough away from this yet for me to feel super comfortable in big index swings coming into the end of the year like I want to be. I'd like to see the dollar get absolutely crushed tomorrow before I consider putting on one of these positions. Powell has, it's like his MO to crush the dollar when he speaks, and he did just that today. So kudos to him. That's what he's best at, is just crushing the American dollar. But I want to see some continuation tomorrow. I want to see more selling here before I get bulled up. You'll see why, again, as we work through some of the rest of this. The biggest thing, excuse me, that we need to get through is, no surprise, Apple's earnings. And I'm kicking myself for not taking the parallel line trade here, because we stopped exactly at it. And I'm such a dummy. This has not been my best week in terms of making decisions. I've been a little gun shy pulling the trigger on things. But Apple reset the RSI right back to neutral. So we have sort of a level playing field coming into tomorrow, given that Apple is above its 200 daily moving average, but below its 50. Those are the two most important to me. No, I don't care about when they cross. I just care about whether price is above or below them or not. Right. So it's pretty neutral. It's a coin toss for Tim Cook tomorrow. I think this thing could go either way, but either way, all eyes should be on it. Typically, just my 2 cents, probably not a great sign if you see it rally super big tomorrow coming into earnings. I might take the gamble on a short on Apple if it can get back up here towards this 50 daily moving average, which is probably tomorrow going to be somewhere around 10 or 176.50, I would guess, if this comes down a little bit. That would be an area if Apple rallies ahead of earnings, where I might take a shot on something with some defined risk above this small trend line here. In the meantime, I have no position, just showing the chart that the bulls have stepped back in prior to the big earnings here. And this thing is no longer in jeopardy like it was sort of free falling there for a minute. Things are much more neutral on Apple. Therefore, my opinions on where it goes from here are also incredibly neutral. That was a really long, fancy way of saying I have absolutely no idea what's going to happen to the price of Apple tomorrow.
The question on everyone's mind tomorrow is, can Tim cook?
Can Tim cook? That's the question. You're absolutely right. I got to be honest with you, my friend. I don't bet against him. I don't, because he has stick saved the market so many times with the dumbest product announcements or whatever it might be that people love to spend their money on. He saves the market time and time again. I think it's a low percentage bet to bet against him. Even if the earnings are garbage, there's still a good chance the market loves it. So it's a dicey bet. And Aisha would probably be smiling if she could hear me say this right now, because she's a huge proponent of never bet against Apple. It's just not a good bet. So we'll see what tomorrow brings, but I'm showing the chart because I'm very neutral and I wanted you to see why, and the neutrality basically across the board. They're right back in this channel right here towards the middle of it. RSI's in the middle. You're wedged in the middle of these two key daily moving averages. Apple's going to move tomorrow. I just have no idea which way it's going to go, but it's going to be very influential.
I think one other thing to touch on is we are coming up on a rather momentous occasion.
What is that?
So December 23rd of this year will mark 110 years, because you mentioned the Fed and the dollar, of the Fed destroying the dollar. That'll be their 110th anniversary.
We should do a celebration.
We really should probably do a sale for everyone. Like, hey,
Yeah,
we know that the
giveaway.
Fed's destroyed your dollar, so we'll make our services cheaper so that we can make sure you can still access it while Jerome keeps talking it down to zero, you know?
The Fed destruction sale, 100 plus years is just pure destruction. I love it. That's good. All right, moving on here. You mentioned gold earlier, so I'm not going to spend a lot of time on this particular chart, but I wanted to provide a little confluence that I'm also bearish gold now after being bullish down here, paper handing it somewhere in this area and missing the rest of the trade. Now I have a bit of a vendetta. I'm just kidding. You shouldn't have vendettas in the market. That's really dumb. But gold is starting to weaken a little bit here. I think the really interesting thing about it has been the fact that it rose during a lot of the dollar pulling back. Those two also have an inverse correlation. So that was incredibly strong. But at this point, I'm in the mayhem camp that I'm more interested in seeing some more downside from gold at this point. But I am being patient and waiting to see once again for the 200 to get lost. It sort of tested it today. I did short gold in the overnight. What was it? 2 days ago and covered those. So I'm no longer short, but I do want to get back in if we lose the 200 now, especially because there's likely to be a lot of stop losses in this zone where people were chasing, because that's what people do with gold. Nobody wants to buy paper gold. They do it because they have to. That's my opinion. You had a lot of chasers in here with concerns about what was happening in the world. There's probably a grip of stops in this area, and I would love to get back in underneath the 200 daily moving average to ride this thing down. With this time, hopefully not paper hand it, with a core position right around the 50, taking that off and maybe getting lucky to catch runners to fill the gap for gold. I am not a gap trader. I want to make that clear to everyone. However, historically, you go back and look on a gold chart, you will find very, very few of them that don't get filled relatively quickly, meaning like within weeks. Gold charts for some reason don't like gaps. I think it's because there's no other way to trade it, but technically, like, how do you value the stuff? So I think you get a lot more of that psychological technical analysis type stuff with products like gold. You see the same thing in things like Bitcoin. That's common when you struggle to evaluate things. The technicals matter more. So this gap really bothers me, although it's not enough of a thesis because we're too far away to just say, hey, I'm going to short gold right now and just hope for the best. I'd like to do this more strategically. Lose support here first. This is clearly support. Look at all the wicks, all the buying. The 200 daily moving average matters to these traders. If they lose it again, that's where I want to get engaged and try to short this thing back down, taking some off, and then maybe capturing this in runners if gold goes down to zero where it belongs. That's my thoughts on gold. Thoughts from you, Mayhem, before I move on?
Yeah, I 100% agree. I just thought you were being very polite when you said that the trading of gold is based on psychology and not, conspiracy theories. But
well, there might be some of that mixed in with the Wall Street metal kids that love this stuff. But I mean what I say, though. I do think it tends to trade a little more technically than most, because there really is not a whole lot of great ways to evaluate the stuff. So you tend to see a little more validity from the technicals. All 100%. Right, so this is an important chart, and this plays into my thesis that it's probably time for me to get long, and we might get a relief bounce. Maybe seasonality is still alive and well. Obviously, I'm nervous to do that given what's going on in the world, just because I think there's a very real risk of escalation and price just absolutely knifing down when people panic again. However, I need to talk about this chart because it matters. This is the put call ratio. And in this COVID era, if you want to call it that, there's been a kind of a bizarre inverse relationship between the put call ratio and the S&P 500 to a degree that was never really there historically. This is one of those things that I used to just ignore because it was all noise. Well, it's been producing some signal in over the last 3 years when it hits extremes. So I have these defined for myself as above 1.275 and below 0.7. That tends to be where I look at, we're in signal land here, meaning like things are getting a little bit extreme. The reason why this chart is interesting is despite the incredible bullish reaction today, there was a lot of put buying in the rally, longer dated put buying. The day's session was absolutely dominated by 0 DTE calls. The call options were staggering today. I mean, just absolutely flooded in. And we haven't seen that in a while. And if those of you that watched my market prep video, we talked about looking for that as a clue that things are about to turn, because we haven't seen it in weeks, to be honest with you. It's been the put buyers, 0 DTEs, that have dominated price. Today, it completely flipped. It was incredible to watch the call options come right back into the market. Now, this is the interesting thing. While that was happening, people are buying longer dated puts. They were buying puts and driving the put call ratio up. This is another reason why I think there might be fuel to the upside. If this continues, I have to believe that that might be big hedging, because you tend to see puts go up when larger players are going to get crazy long stuff. Otherwise, I'm not sure that I entirely understand this, because it's coming back up here towards extreme area at a pretty quick pace. If it continues above 1.275, traditionally, that has produced bounces. Bounce, 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 right? It produces bullish bounces. We're almost there, but yet today was crazy bullish already, right? So it's something I think that we should really think about here, that maybe this time is a little bit different. Maybe you're seeing some legitimate hedges getting put on for the seasonality or the Santa rally into the end of the year. If that's the case, then I need to be a part of that, right? I need to consider getting long here and having some exposure for that into the end of the year. So this is another signal that I didn't really want to ignore, because it caught my eye after the market closed today. I was like, I did not expect that. I would have expected, based on what the VIX did and the 0 DTE action, to see the put call ratio absolutely smashed, right? It didn't look like anyone was interested in downside protection during, watching the S&P today trade intraday. However, they were still buying puts, which I found very fascinating. Anyways, let's zoom in here to close this out, get a little more granular for the day traders. Here is ES zoomed in. We're looking at 2-hour candles here, mainly just to look at the volume profiles. So this is year-to-date volume, last week and the current week right here. This is my pivot, and boy, was it good, and boy, did I fumble it. Really good pivot. And I completely botched it by not being long in a swing position here. Not something I'm proud of. I'm quite disappointed. But if you look at this as a channel, ES sort of climbed back to the mid. In fact, you could draw a trend line down the middle of this thing too, and I think it would still be valid. We're right at that mid area here. We struggled to get over this the prior week. But look over here. This is what Mayhem mentioned earlier. The point of control for the year is right here. All the trading for the entire year, that's right where we're at. Basically right now, we're just like 10, 20 points above it here after hours. But this is what I meant by home base. Price has come back to where all the volume is. This makes it extremely difficult to have a directional bias at this point, because you're sort of in the middle of the chop zone. But the chart tells us something else interesting. If we struggled last week to get any higher, and we're right back to it this week, breakout traders like myself should be licking their chops, because if we go higher from this, it really brings at least this trend line into play, if not more. This would be a pretty serious bullish breakout if we can get back above these outside of value areas from last week. If we can push the highs, man, price could really take off here. So this is the volume perspective. Things are definitely looking pretty bullish, considering you're retesting the prior week outside of value zone. At this time, it's something to take very seriously. When we look at it from an aggression standpoint, this is also the S&P on 30-minute candles, but I'm zoomed in a little more because I want to see the big delta prints, and that's what these blue and red bars are. They're just the extremes. So I told my Sierra chart, don't show me all the bars. I don't want to see them. I only want to see the ones that are extreme. And so the red ones would be extreme selling, where somebody crossed the spread to sell in to somebody. and vice versa for the blue ones. Well, what we can see, and Mayhem sort of alluded to this earlier, a lot of the larger players here, I said they, I hate saying they, that's awful. Some bigger players that can afford to be this aggressive and create these icebergs, they were absorbing during the sell down here. They were the ones crossing the spread. So the buyers were absorbing a lot of this bloody action that we had over the past few weeks. And once again, we saw the same thing when we dipped in here to make some newer lows. The buyers stepped right back in. They're the aggressors. They're absorbing. Well, today is the most blue bars I've ever seen inside of a single session since I started using this chart, which has been a few years maybe. This is the most I've seen in a single session. This was incredibly aggressive. And I know it doesn't look like much because I'm not zoomed in, but trust me, they're clustered in here. You can see how thin these ones are. They're clustered. And what makes it more interesting to me is that it wasn't after the bell, all after the bell, like we see sometimes with the dealer hedging rolling off from the 0 DTE stuff. A lot of times you see some of these bigger prints after the bell. I ignore those because I'm not worried about that. You have some after hour settlement going on, but these were during the session. There was some really aggressive action here from the buyers, the likes of which we've not seen in quite some time. Yes, I know it was FOMC day. I get that. So I want to make sure that that's, this is actually signal and not noise. I need to see some follow through tomorrow. But this is another reason why I would not want to try to fade SPX over its 200 daily moving average, because the buyers have come in here and said, we're still here. We're still soaking up everything you're throwing at us. They've not thrown in the towel by any means. And the reason why this is important, if you're someone that's relatively new to trading or looking at stuff this way, in a really violent sell down, say like the last one we saw was the COVID crash, in my opinion, in 2020, in a really violent situation, this is not what you see. It's dominated by red extreme bars. It is true panic. It's true fear. It's large players coming into the market, crossing the spread to sell the market down. That is crash-like behavior. This is the exact opposite. We still have very interested large buyers. In fact, one of the icebergs they created today was that plus 8,000. I think it got to at 42.60. So there is still active interest from very large players in the market, which does kind of take some of those concerns of like a crash scenario off the table a little bit. Obviously that can change if things escalated, from like a geopolitical standpoint, but from a straight price action and technical analysis point, this is not usually what you see during a crash. And I'm just throwing that out there for people that might still have concerns about getting bullish. This is not the things that I would usually lose sleep over, to be honest. There's large players absorbing and being aggressive and crossing that spread. It's still happening. So the final chart I have here, just to take a peek at where we are, because I thought this was a really cool chart here. It's showing this perfect little kiss back up to this point of control. This is just visible range, so don't get too excited about it, but it just came up in this area and tagged down. And now I had talked about a level before when I was streaming today in the Discord at 54. I did short that today towards the market close, and then I added to it. Turned out to be a little bit of a decent trade, but I'm getting pushed off sides as we speak right now. I wanted to take one final attempt over on EST in case you get the rejection here in this particular area where the market says, now we're going to drift back a little bit during the overnight. There's some singles created during this madness around 42.50. So below 50, I think I'd get a little extra for my money because we'd probably flush pretty good to fill those singles. So I'm sort of this is like my final stand. I shorted some contracts to swing in the overnight. If price does, if we open up right above that 200 daily moving average on SPX or so, anywhere basically above the highs here, I got to abandon that ship and then play for the 20-day moving average up here, which is around 4,300. So this is another way of saying I am bullish going into tomorrow. However, I'm short right now in the overnight, just trying to make a little bit extra during Globex, looking for a pullback. And then tomorrow, this thing ramps out of here. I might be completely wrong on that. But one reason why this 20-day, I think, should be taken very seriously into tomorrow is the 1 DTE options today that were put on that chain. Unfortunately, the market is going to, if you're a bear, unfortunately, the market is going to open up naturally a little bullish tomorrow because you have 10,000 calls that were already purchased, but they're not reflected over on open interest at 4,300 SPX. Right. So that's going to be, where is that for us? Right. Just below it, around 80, I think. Is it a 20-point spread right now? It's pretty close. I think it's around a 20-point spread. So unfortunately, the weight's going to be to the upside. If you're a bear, pay attention to that. You're going to have a lot of open interest at 4,300 tomorrow. The call buying right now does sort of exceed the put buying for 1 DTEs, which tomorrow those will turn into 0 DTEs, obviously. But I made a mistake of not catching the 4,200 exposure earlier this week, and I wanted to make sure I don't do that again, because that was a mistake I was not comfortable with. I missed that, right? So when these orders get placed, the day before, like in a scenario like this, they're not going to reflect on the 0 DTE charts necessarily the same way as you're watching the orders come in live. Those will already be on the books. So I'm saying it now so that that mistake doesn't happen again. There is the largest volume right now at a strike for tomorrow is on the call side, and it's at 4,300 on SPX, just making everybody aware of that. So in terms of what does this translate to me in terms of a pivot, why am I trying to short for a little extra here tonight? 4,240 is the pivot tomorrow. Zero question about it for me. This level is incredibly important in my mind. It represents a lot of this battle that we had right here in the breakout. But one of the things that you often see, which is why I took the risk shorting a little bit for overnight drift, is a retest and then a bounce. So I am looking basically anything above, 4,240. I'm going to favor longs for the day. Below 4,240, I think there's good reasons to try to catch some day trading shorts just back to that big pile at 4,200 on SPX, which is about 4,220 over here on ES. There is still a lot of options, as you saw from Mayhem's chart earlier, stacked there. I think there's a good chance you come down into that area and that it holds. That's what you would want to see. You want to see 4,200 hold once again on a retest, I think, if you're bullish. Because I think that opens up the larger options positioning that Mayhem talked about for future expirations around 4,300 and 4,400. But don't be surprised if we see a retest. That's personally what I'm playing for. I might get it actually shoved in my face tonight, because the market is definitely bid right now. We're up to 42, almost 65 as we speak. So there's a lot of bullishness that just entered the market this week. I just don't want to see anyone get absolutely thrashed trying to short that, because I think based on the charts that we've looked at from a technical perspective, the buyers have some fuel for a little bit of a relief bounce here to push this thing up. We have a lot of key daily moving averages to interact with over on ES, not just the key one on SPX that we're sitting at now, but on ES, you can see the market still cares about its moving averages as well. So I'm looking at the 200 up here around 43.35-ish. There's a lot of key areas to come and interact with above us, more so now than below, in my personal opinion. That's my thoughts. I hope everybody has a great trading day. Mayhem, any final words before we sign off?
Yeah, just for folks that are out there that are trying to figure out how all to position yourself in this market and kind of getting caught in this choppy trading environment, look for what Horst is saying, a market that's in motion for easier trend trading. Consider longer time frames. Swing trades have been something that's really on both sides, long and short, and even in pairs, a real good theme to trade behind this year. And when you have momentum in your favor, it tends to keep going even further than you may think. So quantify that trade using a system. Make sure you understand what your risk is and how you're going to manage your trade and where your exit would be and sizing before you even get into it in the first place. And when you have questions, if you're on the Discord, ask us in the questions room, and we're happy to help and provide a hand and talk more about how we approach trading as well. And while there's not a one size fits all trading style, everyone can learn from everyone else that has any experience.
Yeah, absolutely. I think that's very well said. It's something I value personally too. I value the transparency. I like sharing what I'm doing. No, not all of my trades are going to be winners. I'm going to lose money. That's part of trading. But I think that's what makes the community sort of special, right? Is that we can talk about these things. Why am I thinking what I'm thinking and doing what I'm doing? That part is the most important. And I hope if you're a new Traderade member that you recognize that aspect and how much we value that. I think that's the power, right? right? Nobody really learns how to navigate the markets on their own by just constantly copying somebody else. Unfortunately, there's a ton of that stuff out there on the internet and discords and stuff like that. So we're really emphasizing the opposite. We really want to be open about why we're thinking what we're thinking, so other people can learn how we navigate and adapt any parts of that they like. There's maybe aspects of my trading that people enjoy. There's probably a lot of people that are fading what I'm doing because they disagree with the thesis, but that is powerful in and of itself. So thank you so much for supporting what we're doing here and being a member and watching this video. We'll see everybody soon on the Discord and the website and Twitter. Thanks for hanging out with us this evening. We'll check in soon.